All right, let's get right into it. We're going to talk about the most common and, frankly, the most costly GST mistakes that businesses are making. You know, the kind of errors that practically invite an auditor to take a closer look at your books. These are the slip-ups that can quietly drain your business if you're not careful.
And this right here, this really gets to the heart of the issue. A small GST error isn't just a tiny one-off problem. Think of it like a tiny crack in a dam. At first, it seems like nothing, right? But over time, that pressure just builds and builds until suddenly you're facing a massive, really expensive problem.
You know, what's really important to understand is that we're not talking about some grand scheme to defraud the government. Not at all. We're talking about busy, honest professionals who are making small, totally preventable mistakes that can end up having crippling financial consequences for their business.
Okay, so let's start by digging into the real threat here. We need to understand why these seemingly minor issues can have such a huge impact on your bottom line.
This is probably the best way to picture it. Every single unreconciled invoice, every misclassified service, it's like a small, slow leak in your company's finances. You might not even notice it day to day, but over a few months or a year, it adds up to a significant loss, especially once you factor in all the interest and penalties.
So, if you want to protect yourself from an audit, you've got to learn to think like an auditor. Let's pull back the curtain and see what exactly they're trained to hunt for.
Look, modern tax audits are all about the data. They have powerful software that just churns through your filings looking for patterns and, more importantly, for gaps. An inconsistency in your numbers isn't just a question mark anymore. It's a giant, flashing red light that basically tells them, hey, dig deeper right here. And these are their greatest hits. Mismatched credits, revenue that just doesn't quite line up, using the wrong tax codes, and just general gaps between all your different reports. You could call these the four horsemen of a GST audit.
All right, now let's get into the nitty-gritty. We're going to break down how those issues turn into the four most common traps that businesses fall into time and time again.
So first up, we have the classic mismatch. It's so common. Your GSTR1, that's where you declare all your sales. Then you have your GSTR3B, which is the summary, where you actually pay the tax. Now, when the numbers on these two forms don't match up perfectly, the system's algorithm flags it instantly. No human even needs to look at it. It's all automated.
And as soon as that flag goes up, this is the number you need to worry about. Any tax that was short paid because of that mismatch, it immediately starts collecting interest at a whopping 18% per year.
And that kicks off a nasty domino effect. It starts with an automated notice from the system. While that's going on, interest is just quietly piling up in the background. And if this isn't a one-off mistake, if it looks like a pattern, well, that's what triggers a full, detailed manual audit.
The second major trap is claiming input tax credit, or ITC, that you haven't properly reconciled. So what does that mean? Basically, you're taking credit for taxes you paid on your business purchases. But if your supplier hasn't reported it correctly on their side, then in the eyes of the tax department, that credit you claimed, it simply doesn't exist.
And the consequences for this are a brutal triple whammy. First, they make you reverse the entire credit you claimed. Second, you have to pay 18% interest on that amount for the whole time you held it. And third, on top of all that, you could get slapped with even more penalties. It's a painful combination.
Trap number 3 feels so basic, but it trips up so many people. Just plain bad documentation. I mean, this picture says it all, right? A chaotic mess. Missing invoices, incorrect tax codes, no e-way bills. It's like sending out a formal invitation asking for a deep, painful audit.
And let me be absolutely clear on this. This is the golden rule. When an auditor asks for a document to back up a transaction and you can't find it, you lose. That's it. It's that simple. Your explanations, your arguments, they don't matter. Only the paper trail does.
And our fourth and final trap is all about classification errors. Every single good and service has a specific code, an HSN or an SAC code, that determines its tax rate. If you use the wrong one, whether it's by accident or maybe you're trying to find a lower tax rate, that is a huge red flag.
And the outcome is, well, predictable and very expensive. The department will demand that you pay the difference in tax, plus interest on that shortfall. And since classification can sometimes be a bit of a gray area, this often leads to long, drawn-out, and costly legal fights.
But here's the thing. Good auditors don't just stop at your GST forms. Oh no, they go much deeper, and they start cross-referencing data from your entire financial world.
Here's a question I want every business owner to ask themselves, because you can bet the auditor is going to. They will take the revenue you declared in your GST returns and put it side by side with the turnover you show in your audited annual financial statements. And if those two numbers don't tell the same story, you better be ready for some very tough questions.
Another area they check is something called the reverse charge mechanism, or RCM. This rule gets overlooked all the time. For certain services, think payments to lawyers or goods transport agencies, it's actually your job as the customer to pay the GST directly to the government. If you forget, that's unpaid tax plus our old friend 18% interest.
Okay, so we've spent a lot of time on the problems. We've seen the traps. Now let's pivot to the most important part. How do you actually build a defense system so this stuff never happens to you in the first place?
This is so important to understand. Your GST compliance isn't just about what you do. Your ability to claim that crucial input tax credit is 100% tied to how disciplined your vendors are. If they don't file correctly and on time, guess who pays the price? You do.
So here's a simple but really effective framework to manage that risk. First, create compliance scorecards to track how well your vendors are filing. Second, review those scorecards every single quarter to spot any worrying trends. And third, you have to be ready to block business with vendors who are consistently non-compliant. You have to protect your own business.
And this right here is the end goal. Remember that chaotic, messy file cabinet we saw earlier? This is the polar opposite. When you build strong internal controls and reconciliation processes, compliance stops being a stressful, reactive chore. It becomes a proactive shield that defends your business.
And look at the payoff. It's huge. You're protecting your cash flow. You're avoiding those crippling interest charges and penalties. You dramatically lower your risk of getting dragged into legal disputes. And maybe most importantly, you build the confidence to know that if an audit notice ever does arrive, you're ready.
So let's end on this thought. If you take just one thing away from our time together, let it be this. Stop thinking about GST compliance as just a boring filing task you have to do every month. Start thinking of it as a core business system, just as important as your sales or your operations. Because when you make that mental shift, you turn one of your biggest risks into a powerful strategic advantage.